All right, let's go ahead and begin. Just as a reminder, we won't have class on Friday here in the classroom. I'm going to post a recorded video on YouTube, and I'll email you the link. The link will also be posted on Blackboard, but the bottom line is we will not have a live class meeting on Friday. Looking to next week, you've got homework number 5 due on Monday at 12. So that's an assignment that I just posted a few minutes ago. It's got 4 problems. The answers to the problems are right there next to the problem statement, so you can have an idea of whether you did it correctly. And that'll need to be submitted before you come into the class for the exam. Do you have a question?
Is it Monday, September 23rd?
Oh, you're probably right. Let's take a look. Yeah, thanks for catching that. All right, so Monday of next week is when we're having the exam, and that's also when the assignment is due. So, any other questions about the announcements? Okay, today we're going to continue talking about capitalized cost and capital recovery. You'll remember that for the in-class exercise we worked through on Monday, we didn't quite get to all of the problems. I just really briefly showed the solution on the screen in case somebody wanted to work ahead and finish those, but we'll talk through the solutions today and then also talk about permanent investments. So first, just to pick up where we left off with the previous solution. There was this series of costs followed by a salvage value in the in-class exercise from last class meeting, and I asked you to outline a solution strategy. And by solution strategy, what I mean is just make it a bulleted list before you even begin your numerical calculations. Put together a summary of what steps you're going to take. And so expressing it in terms of this notation where we put things in brackets and look up the factor from that, I think is a good starting point. So what this is showing is that the amount that's already at the present can be spread out over the annual series directly. So this first bullet point here where I'm suggesting move the $8 million to the annual series with find A given P for I equals 8%, N equals 8. This amount that's at year 1 as a lump sum, the $5 million outflow, that first needs to be moved to times 0 with find P given F, and then following that we can do the A slash P, I equals 8%, N equals 8. So, by the way, the order that these things is done does not affect whether the solution is right or wrong. Like, it would be okay to take this $8 million and find the annual equivalent of it first, or you could move this $5 million that I'm calling B, you could move that to the present, combine it with the $8 million, and then move the combined amount to the annual series. And you get the same value, regardless of what order you go in. Okay, then the third step, I'm referring to this $8 million inflow, I'm sorry, $0.5 million inflow at year 8. That's arrow C. So my suggestion is we can find the annual equivalent of that with find A given F. It does not need to be moved to the present necessarily. A slash F has the form of an outflow in the same year as the annual equivalent. So, so with that solution strategy in place, then I can just look up the factor values associated with each one of these bracketed statements. So for example, A slash P for 8% and N equals 8, that factor is going to be this one, the 0.17401. The $5 million, moving it from year 1 to year 0, the factor for that one is 0.9258. So I found the combined amount at year 0 of the initial $8 million and then the $5 million being moved to year 0. And the annual equivalent of that lump sum is $2.2 million a year. Then the annual equivalent of the salvage value is only $47,000. So overall, the annual equivalent is this $47,000 is if you take the salvage value lump sum and find the annual equivalent of it, and that's why it's a positive. And then the other two components are outflows, because we have the $900,000 that's already as an annual series. So the original cash flow diagram already had some component of an annual series, and what we were adding to that was just the inflow and the two outflows. So the overall annual worth here, instead of having a huge variety in how much you have to pay each year, if you wanted to express it as a constant amount each year, it would be just over $3 million in outflows. Does anybody have questions about the overall idea with this annual worth method or any of the specific calculations? Okay, now the final problem on the in-class exercise from last time was a capital recovery problem. And remember, this is capital recovery. Capital recovery is when you have a piece of equipment that costs money at time zero. It may or may not have salvage value at the end of its useful life. Some equipment does, some equipment doesn't. What we're trying to do is find the annual equivalent that is the combined effect of this outflow and inflow. So on the in-class exercise, we had a problem where we're purchasing a septic truck for $85,000 in 6 years, sell it for $18,500. So this is what the cash flow diagram should look like: an outflow at time zero, an inflow at time 6, and we want to find out what is the capital recovery, so the annual equivalent. So capital recovery is the outflow at the present combined with the inflow in the future. And so for this one, I'm finding A given P for a 6-year time horizon and 8% interest, and then combining that with find A given F of the salvage value, so where the factor there is looked up on 8% interest and N equals 6. So what this means is if you bought this equipment, you'd have to make $15,865 in new revenue just to cover the cost of the equipment purchase. And that does not take into account like the equipment fuel or maintenance or insurance or covering your people or any profit you want to earn. This capital recovery amount just represents the difference between the purchase price and the salvage value expressed on an annual basis. So does anybody have questions about capital recovery or this specific example? I see some folks are writing, so I'll give you a moment to finish copying that down. I think last fall there was a problem on the exam related to capital recovery. I haven't written the exam yet for this year, so I don't know what's going to be on it. And I'll probably forget, even if I did tell you, between now and when I write it. But this is an important principle because every time you buy equipment, you need to think in terms of how much additional revenue is required to justify that purchase. And that's what capital recovery can help you to assess, is the annualized cost of owning equipment. My best capital recovery was I bought a used car back in 2009. It was a little Mazda Miata. And I don't know why. It was a frivolous thing, totally impractical, but I live on a windy road and I thought it would be fun to have a convertible that's low to the ground on that windy road. So I bought it for $7,500 in 2009. And I kept it and drove it for 13 years, and then I sold it for $4,500. So, I mean, my cost of ownership was extremely low if you think about the initial purchase price, the salvage value, and then so many years of ownership, it was a very inexpensive car to own. I don't think I'll ever be able to replicate that very low capital recovery when it comes to transportation costs. All right, well, let's move on. Here's just a summary of that same equation that you saw in the solution for the in-class exercise that we just looked at. It says capital recovery is the initial purchase price, finding A given P, minus the salvage value, finding A given F. So on Monday, I mentioned the idea of perspective and how it's important to understand whether the problem is asking the cost of ownership or how much revenue needs to be earned in order to cover the cost of ownership. Because the equipment itself, if you were to express it in a cash flow diagram, purchasing the equipment is an outflow. It's a net expense. But if you're calculating how much new revenue needs to be generated to cover that equipment, it would be the equal and opposite amount. It would be a revenue of that amount, which balances out the outflow. So here's the equation for capital recovery. If you make a deposit to an account and it's earning a certain interest rate, let's just say, what if you found an account that paid 4% interest and you wanted to make withdrawals forever? If you wanted to just be able to draw off a certain amount of money from that account each year, then a infinite series, the amount that you can withdraw is simply just the interest rate multiplied by the principal. In other words, the principal will always be there if all you're taking is the interest that's been earned each year. So for example, if you deposit $100,000 into an account that's making 4% interest, then you could withdraw $4,000 each year infinitely, forever. And it would still equal $100,000 at the end of that transaction where you withdrew $4,000. Now the purchasing power over time is going to decrease. So $4,000 in year one, maybe you could, go on a pretty nice vacation for that. But after 100 years, when prices of things are getting more and more expensive, that same $4,000 isn't going to be able to purchase the same amount of things. So it's income forever, but the value of the income would be declining at the rate of inflation. But in any case, this formula would allow you to find out what is the annual equivalent of a perpetual investment. So if you look at a factor table and you go down through lots of different n values, some factor tables will show even as far as n equals 100. And so look at the find A given P column for 4%. So this is basically saying what is the ratio of the annual equivalent of the present lump sum value. So if you wanted to withdraw an infinite amount of withdrawals over time, then this is converging down towards 0.04 for the 4% table. So for 100, it's 0.0408, but if you went to 200, 300, 400, down to 1,000 and beyond that, it would gradually converge on a ratio of 0.04. The inverse of that is if you have some liability that you're going to either receive income over time indefinitely or you're going to have to pay out indefinitely, then what is the present equivalent of that? So in the previous concept, what we were saying is that the annual amount is the principal times the interest rate if it continues forever. If we just algebraically rearrange that, then we get that the present value equivalent of an annual series that continues forever is just the annual amount divided by the interest rate. So this cash flow diagram is showing what if you were going to receive $50,000 each period forever, what would be the lump sum equivalent of that? And the lump sum equivalent would just depend on the interest rate. So A is the interest on a perpetual investment. And so if we were talking about this $50,000 amount and it was 10% interest, then how much would you need to deposit in the account today? So we would say the amount you need to deposit today is the 50,000 annual series divided by 0.10, so that would be $500,000. And so if you deposited the $500,000 today, then you'd be able to withdraw $50,000 each year from the bank, assuming it's making 10% per year. So permanent investments are things that get built that have a very long useful life. So it may include dams or canals, bridges, things that are huge investments that we want to sometimes know how much should we charge on a toll bridge. If you're going to be charging people to cross the river, and they've just done that recently, I think up by, not Point Pleasant, what's the one like in the northern part of West Virginia, just by Marietta? What is it? Parkersburg. Yeah, do they have a new bridge? I think they've just opened in Parkersburg, and interestingly, it's financed by, I believe, the United Arab Emirates Sovereign Wealth Fund. So it's like a foreign investor bought an old bridge that was in really bad shape, and they refurbished it. They spent tens of millions of dollars getting the bridge fixed up so that it could be continued to be used. And so the question is, how much should they charge for people to cross the road? Well, one of the ways they can look at it, I'm sure there's a lot of different analyses that they can do, but one of the ways to look at what should the toll be to cross the bridge is how many cars per year are crossing the bridge, and then how much did they invest in order to get the bridge functional, and then with the really generous assumption that it lasts forever, you could consider it a permanent investment and then find out if you knew the lump sum price of refurbishing it and you've got some interest rate in mind. That could be the interest rate that they are paying in order to borrow the money to do the refurbishing, or it could be the value of the second best alternative that the Sovereign Wealth Fund could have invested in if they hadn't chosen that bridge in Parkersburg. But there's an interest rate that they take into account, and if you multiply the interest rate by the initial cost of getting the bridge going again, that would tell you how much you need to collect each year in order to cover the cost of refurbishing that permanent investment. So I don't know if that's what they did to assess the toll road crossing in Parkersburg, but last time I was up there, I went the long way because I didn't want to pay the fee. I think it was like more than $5 or something. It was pretty expensive. So I'll just drive an extra 5 or 10 minutes and skip the bridge. All right, any questions about permanent investments before we begin talking about bonds? I've told you before that I'm going to try and warn you whenever we get to topics that students typically misunderstand, so that you can like turn up your focus, put away the video game for a few minutes, and actually really understand what's happening. And bonds is one of those where it seems like even though we'll come back to the subject 2 or 3 times during the semester, a lot of students will never figure out how to value and price a bond. So bonds are ways to finance companies or finance large projects, and what it is in technical terms is an interest-bearing certificate. It's basically an arrangement between a lender and a borrower that says you're going to invest a certain amount now, and then you're going to get your money back in 2 ways. You're going to get periodic interest payments that are paid to you, as well as some cash value as a lump sum in the future. So it basically says you have if you're the investor, you have an outflow now, and then you have inflows over time as an annual series. That's the interest you earn. And then there's a lump sum payback of typically your original investment some years in the future. So I took a screenshot of Charles Schwab. That's my brokerage account is with Charles Schwab. And this was a couple of months ago when interest rates were a little bit higher than they are now. I don't know if you've been following in the news, but today, this afternoon, the Federal Reserve Bank is finally expected to announce the first cut in interest rates in, I think, around 2 years. It's big news. Like, the financial markets are all in all sorts of turmoil, and there's a lot of focus on interest rates coming down. And it seems like the consensus anticipation is that interest rates are going to come down by 0.5%, which is considered a pretty dramatic cut. This was from a few months ago when bonds and CDs and interest rates in general were a little bit higher than they are now. But there are a couple of trends I want to show you here. First of all, U.S. Treasuries are considered a very safe investment. And I know people joke around about the fact that the government has a budget deficit, and a lot of people worry about whether they'll have Social Security when it's time for them to retire, because Social Security is paying out more money than it's got coming in. But U.S. Treasuries are considered the safest investment in the world because the United States government so far has never defaulted on its interest or principal obligations. They've always paid their money back, and very few companies or governments can say the same thing. But maybe more importantly, the reason why U.S. bonds are considered really safe investments is because the U.S. government has the legal right to tax the most valuable thing in the world, which is the U.S. economy. And so, they have the legal right to impose taxes on this engine of growth and wealth, and so they have a pretty good assured source of income. So the point is that other organizations sometimes have to pay more than the U.S. government does in order to borrow money. The longer you are willing to loan your money to the government, you'll notice that in this instance, the interest rates are generally going down. And that's called an inverted yield curve, and that's pretty strange. Most of the time, under ordinary circumstances, the longer you're willing to loan money to the government, the interest rate would be a bit higher than the short-term deposits. And by the way, these are all on an annualized basis, but it's kind of rare right now because people have been expecting that with rates being relatively high right now, they're probably going to go down in the future, and that's why we've had an inverted yield curve. But this just basically shows if, for example, you were going to buy Treasury notes that have a 6-month duration, then the day that I took this screenshot, those Treasuries had a yield of 5.52%, meaning that on an annualized basis, for every $100 that you are investing, you'd get back that 100 plus $5.52 in interest. So the trend that we saw here is that the longer the commitment, the lower the interest rate. That's pretty unusual, but that's just the way things have been over the last couple of strange 2 years. So what you need to know for problem solving, and the homework goes over bonds mostly, what you need to know is that you're going to get your money back when you are a bond investor through the interest payments and the return of principal. And so the variables that we assigned here, the interest payments are some interest rate times Z, which is the initial purchase price of the bond. And then the return of principal, assigning the value C here, that's just a lump sum amount. Oftentimes, C and Z are the same. So oftentimes if you're buying a bond for $50, then you're going to get $50 back in the future as well. But not all bonds are that same way. Sometimes the redemption price is higher or lower than the initial purchase price. So there's two main components of the value of a bond. So V sub n is just saying the value of a bond n periods prior to the redemption of the bond. So remember that you're getting money back two ways. You're getting a lump sum return of principal in the future, and that's the first term here. It's a single payment. And then you're also getting your money back as the interest payments. So R times Z, the product of those two things together, is the interest amount that you get. So R is the interest rate, Z is the face value of the bond, so the interest amount is R times Z. So the present value for the redemption price plus the present value of the interest payments tells you the value of a bond now. One of the nice things about a bond compared to a CD is when you buy a CD from a bank, you're making a commitment to leave your money in the bank for a certain period of time, and you can't get your money out unless you pay a penalty. So if you bought a certificate of deposit with a 5-year horizon and you paid that to Chase Bank for a 5-year CD, if you take your money out before the 5 years, then you're going to pay a penalty, and a pretty typical penalty would be 3 months of interest. And so that's not the end of the world. It's not going to bankrupt you necessarily, but I mean, it's annoying to lose 3 months of interest for that. So bonds, on the other hand, there's a secondary market where bonds are sold and purchased prior to their redemption. So the agency that originally issues the bond, like the U.S. government, they're going to get their money from you and take that money to buy a bomber or pay interest or whatever the federal government is doing. But once somebody's purchased a bond, they don't have to wait until the end of its life in order to get their money back. They could just sell the bond on a secondary market. And when they do that, sometimes the bonds have more, sometimes the bonds have less value than when they originally purchased them. Like I own some bonds right now that I bought back when interest rates were high. And now that interest rates are going lower, the bonds that I bought back then are going to become more valuable. Because the bonds that I bought a couple of months ago, they pay interest at a higher rate. And so when the Federal Reserve lowers interest rates and the U.S. government starts to pay lower interest rates for the bonds that they're issuing, the new bonds that they're issuing, the old bonds that are getting paid at the higher interest rate become more valuable. And so on the secondary market, oftentimes the purchase prices are higher or lower than the face value of the bond. So this just takes a little bit of practice before it becomes natural and makes sense. So let's do this in-class exercise. Let me hand out the paper for you. Okay, the solution's up on the screen if you want to have it look to see if you're headed in the right direction. So I think what sometimes throws people off with bonds is the fact that there are two different interest rates. One interest rate is what the bond issuer is actually paying. And then that's here what we're calling the bond rate, R. The other interest rate is the yield rate. And so you may be asking, like, if the bond issuer is only paying 3% per period, then how could you earn a yield of 4% per year per period? You know, like the person who's paying the interest is giving you 6% per year, but you want to earn 8% per year. And the reason why you're able to do that is by purchasing the item at less than the face value. So the face value is 1,000. This is saying if on the secondary market you're able to purchase the bond for $864 instead of 1,000, then that yield is 8% per year. Because what you're doing is you're paying a discount now and you're getting a stream of revenue over time, the interest payments, and then a lump sum in the future. And the compounded present, the discounted present value of all those future amounts is 864, which means you'd have a higher yield than the bond rate. So does anybody have questions about the first one? If not, then I'll show you how to set up the other two on the computer, because I think there may be some problems on the homework where it's beneficial for you to use Excel rather than trying to solve by hand. All right, so if you'd like to follow along, you can start up Excel. Here's the second problem. Let me paste it into a blank workbook so that we can see the problem statement as we're working. Okay, so you wish to invest in bonds that have a face value of $100. The bond rate is 6.5% per year nominal. That means without compounding taken into effect. And the bond interest payments are paid twice per year. So that's going to tell us if it's twice per year, the interest rate per period is different from the interest rate per year. And that also tells us that the number of periods is different from the number of years. So anytime you see anything that's anything other than once a year, you should automatically be thinking about adjusting N and the interest rates. If you're willing to accept a yield rate of 5% per year, how much should you be willing to pay for the bonds? All right. So I'm going to set it up this way because this is going to be kind of an iterative process. I'm going to define N and R. Let me make it a little bit bigger. I'll define I, C, Z, R times Z. And let's just start there. So N, the number of periods in this problem statement is 25 years twice per year, so N is 50. Okay, R, the bond rate per period. Let me, by the way, put notes here on what this is. Number of periods before redemption. Okay, R is the bond rate per period. And here it says the bond rate is 6.5% per year. And so then the bond rate per period will just be that divided by 2. So 0.065 divided by 2. So the bond rate per period is 3.25%. Okay, I is the yield rate per period. And here it says that we're accepting a yield rate of 5% per year. So per period, that would be 0.05 divided by 2, 2.5% per period. Okay, C is the redemption price. The redemption price is $200 according to the problem statement. Here it's saying the bond is redeemable for $200. Z, the face value. The face value of the bond is $100. Okay, so if the bond rate per period is 3.25%, then that means the amount of interest it pays each period, R times Z, is the amount of interest paid each period, equals R times Z. It's based on the face value. Okay, what we're going to need to calculate is the PV of the redemption price at the end of the bond life. And remember, the equation for that is we take C, the redemption price, and we discount it. P/F, I%, N equals something. So we're calculating the present value. Calculating the present value of that, and we'll just use the PV function here. So equals PV. Okay, the rate that we should use here, I remember, is the yield rate. So I'm going to select the yield rate for that. The number of periods is 50. And now this is the redemption price. And so should I put that redemption price as a PMT or as a FV?
PMT.
No, we would, if it's a single lump sum value, it's not a recurring payment, it's a single future value. So I'm going to skip over the PMT, and I'm going to put minus of the amount, the redemption price, into the FV field. And so what that says is that if you're discounting, $200 is what you get in 50 periods. The present value of that $200 is $58.19. And then the other component of the bond's value is the PV of the interest payments. And the formula for that is R times Z. And so the way that R times Z times P/A I%, N equals, in our case, 50. Okay, so let's do the PV function. The rate that we're using here is the yield rate. Number of periods is 50. And now the amount that we're referring to, we do put it into the payment field. So it's the minus of this $3.25. We want to find out if you took all of those interest payments and found out their present value of them, it's $92.18. So V sub n is just, V sub n is the sum of the two components of value, the redemption price and the interest payments. So this now represents, this is the value of the bond. This is how much you should pay to receive 8% nominal yield. Is that what we're going for here? No, 5% yield rate to receive the desired yield rate of 5%. Okay, so we've just valued the bond. The money you're getting back is $200 in the future, which has a present value of $58.19 when you discount that at the yield, the desired yield rate. You also get back the interest payments over time, and the present value of those interest payments is $92.18. So the overall value of the bond right now is $150.37. All right. Last problem. A certain bond will pay $55 4 times a year for 10 years, followed by a lump sum payment of $1,000 10 years from today. If the bond price is $900, then what is the yield of the bond? All right, so let's start a new tab here. N, R, I, C, Z, and R times Z. Similar setup as before. N for this problem is 40. R we don't know yet. I this is going to start with a guess. let's just say 1% is a starting point. C, which is the redemption price, is 1,000. And then the face value of the bond, it just says here, a certain bond will pay $55 4 times per year. So we don't know what is the rate or the face value, but we do know R times Z is 55. So the face value rate of the bond, not known. Neither is the face value. But what we do know, and what's more important, is R times Z. Okay, so PV of redemption, and then PV of interest. So if this is the 1,000 is the redemption price, what we're going to do is we're going to find out the equals PV of this guess yield rate. I'll start with the 1%. We're going to keep changing that. NPER is 40 periods. And that redemption price, we skip over the payment field, and it's minus of the amount. Okay, so it would be 671 if it was 1%. We need to also calculate the value of the interest using the PV, starting with the guess interest rate. NPER is 40, and this time minus of the R times Z. Okay, now the total, V sub n. As before, we add the two, redemption and interest together. And this is saying if the bond price is 900, then what is the yield of the bond? So we know that the bond price is 900. This would be the bond price if the yield was 1%. So we can do iteration, changing the yield over and over until we find out what is the rate that gives us the bond price close to the $900 that we know. So here, data, what if analysis, goal seek. So set this to 900 by changing the yield rate. So here's the answer. The answer is a yield rate of 6.18% per period. 6.18% per period, which is equal to a nominal annual yield of 24.72%. All right, I've kept you over. It's 12:51. I owe you a minute. I'll pay you back with interest in the future. I promise it'll be compounding interest, so you'll get maybe 2 minutes back in the future. Remember, Friday's class will be online. So I'll see you on Monday for the exam.